Welcome to this week's edition of Trade the Trend, a weekly video about where the stock market is going. This video is going to focus on the SP 500. I'm going to cover the ASX 200 as well as copper, gold, oil and uranium in a separate video. I'll leave a link for that in the description section below. As always, everything today is general commentary only, doesn't take your personal situation into account. With all of that said, let's get into our first chart. So we're going to start with the S&P 500. And did we just see a key reversal day in the S&P 500? And technically speaking, we did. So let me just explain. So a key reversal day is when a market opens above the previous close, trades to a new high, and then closes at a new low, a low below that of the previous day. We don't see that many key reversal days, but when we do see them, they can be a good indicator of at least a pause in the trend. Now, we saw another one in July last year. So we'll just go over to July and just zoom in on the price action a little bit more so that you can see it. Here it is here in July. So you can see the open above the previous close, new high, and then fell and closed at a low below that of the previous day. And well, as we know, this one led to an 11% correction over several months. Now, that of course doesn't look too good, and you look at that and you start bracing for the worst, but that doesn't necessarily need to be that way. They play out in different ways. Here's another example from December. So just zooming in on this December example. Here's another one here. Doesn't quite meet the definition in that the open was fractionally below the previous close, but it does in that the market then made a new high and then closed below the low of the previous day. And the price action that came after that, well, it was about 4 or 5 weeks of sideways consolidation before new highs. So these patterns can play out in different ways, and that's of course if they even do play out. Sometimes the market can just turn around and rally again nonetheless. But they are interesting to be aware of and just understand what could happen from it. So they're called a key reversal day. So I know that sounds ominous, but it doesn't necessarily mean a large sell-off is coming, as we've just gone through and had a look at. So the big question I think I've been asking over the last couple of months, really, from the March high, the big question has been: is this all part of an ongoing consolidation, a larger consolidation of that big rally we've had off the October lows, or did it all end in mid-April and this is now part of a new rising trend? I think the reversal day suggests that we should be prepared for more consolidation to develop over the next few weeks. The persistence of this strength off the April low over the last 5 weeks, I think it rules out my initial thinking that a range was going to form below the April low. So initially I thought the market might just track sideways below that April low for several months. So we're at a new high now, so it does rule out that possibility. But I still think the potential of a pullback towards the 50 or maybe the 100-day moving averages is, I think that possibility is still wide open. Also interesting to have a look at the Dow Jones over the last couple of days, and the selling has been more pronounced. Quite a decent drop, 1.5% on Thursday, and that continues from the high earlier in the week. So there's been a clear halt to the upward momentum in the Dow. So an initial sharp pullback, as we've seen, it typically doesn't reverse within a few days. So I think that's another factor that plays into the consolidation scenario. And just of passing interest, you just look at where the Dow peaked, 40,000. And it's one of these things, big round numbers, they often provide a psychological resistance point. And I don't think we need to put too much weight on this, but it is something that has happened over time in indices around big round numbers. So it's just of interest to see that the Dow is actually pausing at 40,000. I think what is of more interest to me though is what's happening in the S&P 500 equal weight. So we've just looked at the S&P 500, which has just had this key reversal from an all-time high, coming over to the S&P 500 equal weight. So this is an ETF, an equal weight version of the S&P 500. And so last week I was talking about some divergence between the S&P 500, which has made a new all-time high, and the S&P 500 equal weight, which had at that stage fallen short of its all-time high, hadn't quite made that all-time high as yet. And a viewer suggested to me in the comments, he said that, look, it's not actually divergence because the equal weight at the time was still rallying. And his point was you get divergence when the market actually turns lower. And look, that's a fair point. Maybe it could have been looked at that way, but maybe a better way for me to have explained it at the time was non-confirmation. The equal weight wasn't giving confirmation of the highs we were getting in the S&P 500. But either way, the non-confirmation continues, and I think this is a sign of that consolidation possibility. With the equal weight just pulling back from those levels it was at last week, it just makes that non-confirmation even starker than it was when we spoke last week. Another thing that gets my attention is that the equal weight is also down. If you look at Thursday's decline, the equal weight is down about twice as much as what the S&P 500 was down on Thursday. You might ask, so why is that? Why is the equal weight down more? And it comes down to this stock. Let me quickly show you. This is why the equal weight's not down by as much. It's due largely to Nvidia. So Nvidia has gapped higher on Thursday due to strong results, and Nvidia makes up about 5% of the S&P 500, but in the equal weight, it's only 1/500th, because it's equal weight, of course, isn't it? It's 1/500th of the S&P 500 equal weight, so it doesn't have as much influence. And so this is why we get that difference. Now, of course, Nvidia is a key company, but in terms of the stock market, I want to see broad participation in a rally. And at the moment, that's just not what we're seeing. So from that perspective, that's why we're seeing the equal weight off more, and maybe then that flows through to that more consolidation possibility. Now, if you're getting some value from this, please hit that like button. Please leave a short comment. Just, hey, thanks for the video. It just tells YouTube you're watching. YouTube then shows other people. Helps me heaps, so please do that. Now, I'm just going to wrap up with a quick look at the Russell, the small caps, the Russell 2000. And first thing I'm going to do, I'm just going to tidy up this chart a little bit. I've had this overhead resistance here for over a year now, and it marks these peaks during the 2022 and 2023. But as we can see over the last 6 months, it hasn't really been respecting this level enough. It has had a bearing on it, but it's too inconsistent. So I don't think it adds value anymore. And this is something we should always do with our charts. Clean up things which no longer have the relevance they once may have had. Remove the clutter, helps you see new patterns and new setups with more clarity. So having done that, this still remains a range-bound market, and it has since pretty much all of this year so far. Really, it's really been largely range-bound, and I think we've seen the initial liftoff from this large base. So I think this is a large basing formation formed over a couple of years. I think we've got the initial liftoff from that base, but after a strong rally off that October low, it's now just taking time. It's taking time to consolidate. I think there's a lot of potential here, but for now, I think it's a case of being patient and waiting for definitive breakout. We haven't really had that. We've had tests to the upside, which are then quickly pulled back. I think we've got some good levels to watch now. We're watching the April high and also the May high, a breakthrough this region here. I think that could then potentially set this into play. But in the meantime, I think it's a case of wide trailing stops on profitable positions. And this is with the stock market generally. Wide trailing stops on those profitable positions and having an exit strategy for any new positions. I think the overall trend in the stocks generally from the S&P through to the small caps, I think the overall trend remains up, but there could be a few bumps along the way. So let's call that a wrap for this week. Let's leave it there. Thank you for joining me. Been great having you with me. Hopefully that's been helpful. I look forward to coming back and talking to you next week. Till then, bye for now.